2026 is not a growth year for most households. It's not a year for speculative bets or chasing the next hot stock. The economic landscape has fundamentally shifted, and the strategies that worked before are no longer effective. It is a control year. A year where managing money correctly matters more than chasing returns. Control means knowing exactly where every dollar is going. It means building a financial fortress around your household, one that can withstand economic uncertainty. It's about precision, intention, and defense. Most people still use money systems built for a zero-rate world. For over a decade, central banks kept interest rates near zero. In that environment, holding cash felt like a penalty. The only way to grow your money was to take on risk in the stock market or other assets. That world no longer exists. The era of free money is over. We are now in a higher-rate environment, and this changes everything about personal finance. The old playbook is not just outdated, it's dangerous. Interest now pays again. This is the single most important financial shift for households in a generation. Your cash, when placed correctly, can now work for you, generating meaningful, low-risk income. But only if you know where to keep your money. The difference between the right account and the wrong one can be hundreds or even thousands of dollars per year, with no additional risk. Banks have quietly changed the rules. They are not obligated to pass their higher earnings on to you. They create complex tiers, promotional rates that expire, and new account types designed to maximize their profit, not yours. And most people have not noticed yet. They suffer from financial inertia, keeping their life savings in legacy checking or savings accounts that pay virtually nothing. This is a silent tax on their wealth. Personal finance in 2026 is about positioning. It's about structuring your accounts and cash flow to benefit from the current environment, regardless of what happens next in the markets. Not prediction. Trying to guess whether the market will go up or down is a losing game for most. Positioning is about building a system that is robust by design. Those who adapt early gain stability. They build a strong financial foundation, reduce money-related stress, and create a buffer against unexpected events. They are in control. Those who don't fall behind slowly. It's not a sudden crash. It's a quiet erosion of purchasing power and missed opportunity. A death by 1,000 cuts as inflation and low yields eat away at their savings. This video focuses on protection first. We will build your financial shield. We will secure your cash and make sure it's working its hardest for you in a safe, reliable way. Growth comes second. Only after your foundation is secure should you even consider taking on more risk for higher returns. High-yield savings accounts. This is the cornerstone of your new cash strategy. We'll show you how to find the best ones and avoid the traps. Treasury bills. A way to lend money directly to the U.S. government for a guaranteed return. They are considered one of the safest investments in the world. Credit behavior. In a high-rate world, carrying credit card debt is more punishing than ever. We'll cover strategies to manage and eliminate it. Bank strategy. Using multiple banks strategically can protect you and optimize your returns. We'll explain how to set this up. These are the boring tools that quietly win. There's no glamour here, no talk of 10-baggers or crypto fortunes. This is about methodical, disciplined execution. Boring money decisions outperform exciting ones. The thrill of a speculative win is powerful, but the quiet confidence of a stable, growing cash reserve is what builds lasting wealth. 2026 rewards people who understand cash flow. It's the lifeblood of your financial health. Understanding how much comes in, how much goes out, and what the surplus is doing is the most critical financial skill. Not people who chase headlines. Financial media is designed to generate clicks, not to provide sound, personalized advice. Reacting to headlines is a guaranteed way to lose money. Liquidity is power in uncertain cycles. Liquidity means having cash that is easily accessible. It gives you options. It allows you to handle emergencies without going into debt and to seize opportunities when they arise. Cash is no longer passive. For years, we were taught that cash is trash because it was losing value to inflation without earning any interest. That has changed. Cash is strategic again. It is now an active part of your portfolio, a tool for stability, income, and opportunity. How you manage your cash is a primary strategic decision. Smart households treat money like a system. They don't just have a pile of money. They have a structure. Different accounts for different jobs, automated transfers, a clear, logical process that runs on its own. Not like a guessing game. A system removes emotion and guesswork. It replaces anxiety with process. It ensures you are making optimal decisions consistently without having to think about it every day. Small optimizations matter more now. That difference between 0.001% and 5% might seem small as a percentage, but it translates into real money. For a $20,000 emergency fund, that's the difference between earning $2 and earning $1,000 a year, especially in where money sits daily. Your operating cash, the money for bills, groceries, and daily life, is often the laziest money. Optimizing this is the first and easiest win. This is where most people lose quietly. They are loyal to the big bank they've used for 20 years, not realizing that loyalty is costing them a significant amount of money every single day. They park money in low-yield accounts. The bank then takes that money, your money, and lends it out or invests it in bonds that earn the new, higher market rates, while banks reinvest it aggressively. They are capturing the benefit of the new rate environment. The spread belongs to the bank. The spread is the difference between what the bank earns on your money and what it pays you. Right now, that spread is massive, unless you move your money intentionally. By choosing a high-yield savings account, you are essentially cutting out the middleman and claiming a larger piece of that spread for yourself. 2026 is about reclaiming that spread. It is a conscious act of taking back what is rightfully yours. It is the foundation of your new money system. Households that optimize cash win first. Before they even think about stocks, bonds, or real estate, they make sure their cash foundation is solid and productive. This single step puts them ahead of 90% of the population. Risk comes later. The desire to jump straight to high-risk, high-reward investing is a trap. It's like trying to build the roof of a house before the foundation has been poured. Only after stability is built. Your secure, high-yield cash reserve is that foundation. It provides the stability that allows you to take calculated risks later, from a position of strength, not desperation. This is the foundation of modern personal finance. It's not the most exciting part, but it is the most important. Everything else we discuss will be built on top of this, and most people skip it. They hear about rising interest rates, and their first thought is how it affects the stock market, not how it affects the cash sitting in their bank account. They rush to investing. They pour money into the market, hoping for growth, while their financial base is leaky and inefficient. Before securing their base, they have no emergency fund, or the one they have is earning nothing. When an unexpected expense hits, they are forced to sell investments at a loss or go into high-interest debt. That mistake compounds negatively. It creates a cycle of financial fragility. Every step forward is met with 2 steps back. It's a constant, exhausting struggle, especially in high-rate environments. When rates are high, the penalty for financial mistakes is magnified. The cost of debt is higher, and the opportunity cost of lazy cash is greater. Rates amplify good and bad decisions. A good decision, like moving to a HYSA, is rewarded more. A bad decision, like carrying a credit card balance, is punished more severely. The stakes are higher. 2026 is unforgiving to sloppy systems. If your finances are a mess of random accounts, manual bill payments, and no clear strategy, this environment will expose every weakness. But generous to disciplined ones. If you have an automated, optimized system, this environment will reward you consistently. your wealth will build quietly and predictably in the background. Discipline is the real advantage. The willingness to do the boring work up front, to set up the right accounts, automate the transfers, and build the system, is what separates the financially secure from the financially fragile, not income. You can out-earn a bad system for a while, but it will eventually catch up to you. A disciplined person with a modest income will build more wealth than a high earner with no system. Not luck. Luck is fleeting. A system is permanent. This is about taking control and engineering your own financial success, not waiting for a windfall. In the chapters that follow, we will give you the exact blueprint to build that system. 20 Min done. Let's talk about the new foundation of your financial stability in 2026. High-yield savings accounts, or HYSAs, are no longer just a good idea or an optional upgrade for the financially savvy. They are a baseline requirement for anyone serious about protecting their money. Think of an HYSA as the modern version of a standard savings account, but supercharged. While your traditional brick-and-mortar bank might offer you a token interest rate, HYSAs are designed to make your cash work for you, earning a rate that meaningfully combats the slow erosion of inflation. Yet, despite this clear advantage, a surprising number of people still keep the bulk of their savings in traditional banks. It's a habit born from decades of conditioning, a sense of loyalty, or simply the inertia of sticking with what's familiar. The result? They're earning mere fractions of a percent on their hard-earned money. We're talking rates like 0.05% or even 0.001%. It feels like nothing because it practically is. In the financial landscape of 2026, that gap between what you be earning and what you earning is incredibly expensive. Let's put it in concrete terms. If you have $10,000 saved for an emergency, a traditional account might give you $5 over the course of a year. That won't even buy you lunch. The very same $10,000 in a competitive HYSA could earn you $450. That's a significant difference. It's the cost of a utility bill, a car repair, or a flight for a weekend trip. Choosing to leave your money in a low-yield account is like paying a voluntary tax for inaction. What's changed is the speed of the market. HYSA rates fluctuate much faster now. In the past, you might see rates adjust a few times a year in response to major Federal Reserve decisions. Today, online banks are far more agile. They adjust their rates weekly, sometimes even more frequently, to stay competitive. This isn't the old world where you could set and forget your savings account for years. The era of blind loyalty to a single bank is over. In fact, it's being penalized. Loyalty is no longer rewarded. Mobility is. The smartest savers in 2026 have become strategic nomads. They don't marry one bank. They build a roster of trusted, high-performing options. They understand that their primary relationship isn't with a brand, but with their own financial well-being. This means actively monitoring the market and being prepared to move funds to the institution that offers the best combination of yield and safety. A key part of this strategy involves managing promotional rates. Many online banks attract new customers with very high introductory APYs. But these rates are often capped, lasting only for a set period, typically 6 to 12 months. After that, the rate can drop significantly, sometimes to their standard, less competitive level. Smart households are vigilant. They track these expiration windows like a hawk. They set calendar reminders 2 to 4 weeks before a promotional rate is set to expire. This gives them ample time to research the next best option and initiate a transfer, ensuring their money never sits idle in a lower-yield account. This simple act of rotating accounts once or twice a year can add hundreds of dollars to your savings, all without taking on a single ounce of market risk. As we follow the yield, we must also prioritize safety. This is where FDIC and NCUA insurance becomes more critical than ever. The standard insurance limit remains $250,000 per depositor, per insured bank, for each account ownership category. With average household cash balances higher than in previous decades, more families are finding themselves approaching or exceeding this limit. The solution isn't to stop saving, it's to be strategic. Spreading your funds across multiple, separately insured institutions is the correct way to reduce risk and ensure every dollar is protected. If you have $300,000 in cash, for example, you should not hold it all in one account. Instead, you could place $150,000 in an HYSA at Bank A and $150,000 in an HYSA at Bank B, keeping you fully insured at both. It's crucial to understand the precise role of an HYSA. This is not an investment account for generating wealth or chasing high-risk growth. It is a tool for capital preservation, control, and liquidity. This is where your most critical cash reserves belong. Your emergency fund, covering 3 to 9 months of living expenses, belongs here. Funds for a down payment on a home that you plan to buy in the next 6 to 18 months belong here. Money you're setting aside for known, large, short-term expenses like property taxes, tuition payments, or a new car, that money belongs here. Essentially, any cash you cannot afford to lose and may need to access within a couple of years should be parked in an HYSA. This brings us to a vital consideration in 2026, the balance between yield and access. The highest possible APY isn't always the best choice if it comes with restrictive terms. Yield plus access matters, not yield alone. Some institutions may offer a top-tier rate but impose stricter limits on withdrawals or have longer transfer times. Delays cost you flexibility, which is the entire point of an emergency fund. In 2026, we're seeing more banks enforce limits on the number of instant withdrawals per month or charge fees for exceeding them. Standard ACH transfers can still take 3 to 5 business days. When an emergency strikes, you need to know you can get your money quickly and without penalty. Therefore, liquidity terms must be checked with forensic detail. Before you open any new account, read the disclosures carefully. The fine print has changed. Look for any monthly maintenance fees, minimum balance requirements to earn the stated APY, and especially the policies on withdrawals and transfers. Smart personal finance is now detail-driven, not headline-driven. Don't be swayed by a flashy banner ad. Do the 5 minutes of due diligence. It will save you from headaches and unexpected costs down the line. So, let's recap. Your HYSA is your first layer of financial defense. It is the stable foundation upon which everything else is built. This is the account you perfect before you seriously consider investing in the stock market, before you dabble in any form of speculation, and before you chase aggressive growth. It provides the safety, structure, and peace of mind that allows you to take calculated risks elsewhere. Take a moment now. Pause the video and look up the current rate on your primary savings account. Compare it to the top HYSA rates available today. The difference is your first call to action. 40 min done. Treasury bills are having a quiet comeback because they solve modern problems: safety, yield, predictability. In 2026, uncertainty favors T-bills. Short durations matter most: 3-month, 6-month, 1 year. Laddering is the key strategy, not lump sum investing. Ladders maintain liquidity while locking yield. This reduces reinvestment risk and timing anxiety. Households now use T-bills like savings, but with better structure. They replace idle checking balances with earning instruments. Treasury direct usage continues rising. Banks know this. That's why HYSA competition increased. T-bills pressure banks. Banks respond with limits and rules. Smart households exploit the competition. This is legal arbitrage and completely underused. T-bills also help discipline. They prevent impulsive spending without locking funds long-term. This balance matters in 2026. Volatility punishes rigidity. Flexibility wins. T-bills provide that flexibility. Without market swings, no charts to watch, no panic selling, just predictable outcomes. That's why smart money uses them. 60 min done. Welcome to the new era of credit. By 2026, the landscape has fundamentally shifted. The easy credit of the past is a memory, replaced by a system that demands more discipline, more awareness, and a more strategic approach from every household. What worked before, simply paying your bills on time and keeping an eye on your score, is no longer enough. The rules have been rewritten, and understanding them is the first step to not just surviving, but thriving financially. Let's break down exactly what has changed and what it means for you. First, approval standards are significantly tighter. Lenders are more risk-averse. They're scrutinizing income sources more rigorously, requiring more documentation, and looking for longer periods of stability. A good credit score might get your application looked at, but it won't guarantee an approval. They're digging deeper into your overall financial picture, meaning your cash flow, savings, and debt-to-income ratio are under a microscope. For those who are approved, and even for existing accounts, credit limits are less generous. Banks are actively managing their exposure to risk, which translates to lower starting limits for new cards and proactive limit reductions on existing accounts, a practice known as credit line trimming. This can happen without warning, especially if your usage patterns change or if broader economic indicators shift. And if you carry a balance, the cost is severe. Interest rates now punish balances faster and more aggressively. The days of low introductory APRs are fading, replaced by variable rates that can climb quickly. Carrying even a small balance from month to month can lead to hundreds, if not thousands of dollars in extra interest payments over the year. The math is simple and unforgiving. Carrying balances is more expensive now than ever before, even for those with excellent credit scores. Alongside this, minimum payments have quietly increased. Regulatory changes and internal bank policies have shifted the formula. Instead of a simple 1% of the balance plus interest, you might see minimums calculated at 2% or even 3%. This forces you to pay down debt faster, but it can also put a significant strain on your monthly cash flow if you're not prepared for it. And the safety nets are smaller. Penalty APRs now trigger much sooner. A single late payment, once given a grace period, might now instantly reset your interest rate to the maximum penalty rate, often exceeding 30%. This single misstep can have a catastrophic effect on your ability to pay down your debt. This brings us to the most critical change. Your day-to-day credit behavior now matters more than your traditional credit score. While the score is still a factor, lenders' internal risk models are now heavily weighted towards your recent observable actions. Of all these behaviors, one stands above the rest. That metric is credit utilization. It is by far the most heavily weighted behavioral signal in 2026. It's a simple ratio: the amount of revolving credit you're using divided by your total available credit. To a lender, a high utilization rate signals financial stress. It suggests you're reliant on credit to make ends meet, making you a higher risk. To master this, you must understand the difference between your statement date and your payment due date. Most people pay their bill by the due date, but the balance that gets reported to the credit bureaus is typically the balance on your statement date, which is often weeks earlier. This means you could charge $4,000 on a $5,000 limit card, pay it in full by the due date, and still have a dangerously high 80% utilization reported for that month. The key tactic is to make a payment your statement date to lower the balance that gets reported. Smart households treat credit as a precision tool, not as a form of income. They keep their reported utilization low intentionally. The old rule was to stay below 30%. The new rule for top-tier credit health is to stay below 10%. This demonstrates control and predictability, which are the traits banks reward most. It preserves your future access to credit, ensuring it's there when you truly need it for an opportunity or an emergency. The second critical behavior is payment automation. Smart users automate payments to avoid late marks entirely. But the strategy is more nuanced now. Don't just automate the minimum payment. Set up autopay for the full statement balance to clear your debt each month and avoid interest. Schedule this payment to occur a few days, the actual due date, to account for any processing delays. This simple, defensive setup eliminates the single most damaging event to your credit profile: a late payment. Pause the video now and check your autopay settings for every single one of your credit accounts. Finally, practice good dispute hygiene. Review your statement every month, line by line. With the rise of digital payments and subscriptions, fraudulent or incorrect charges are common. Don't just pay the bill. Verify it. If you find an error, dispute it immediately through your card issuer's official portal. This not only protects your money, but also creates a record of you being an engaged and responsible account holder. In summary, the credit environment of 2026 is defensive, not aggressive. Those who adapt by mastering their utilization, automating their payments in full, and diligently reviewing their statements will preserve and even enhance their financial power. Those who don't will see their limits cut, their rates rise, and their financial flexibility vanish. In a tightening economy, that flexibility is power. Credit should be a tool that supports your liquidity, not a drain that replaces it. This new discipline is not about restriction, it's about building a foundation of protection that gives you freedom and control. Banks quietly changed policies. Overdraft terms tightened. Transfer delays increased. Fraud holds last longer. Cash availability is restricted more often. This impacts emergency access. Smart households spread banking risk. Multiple institutions. Multiple access points. Single bank dependence is risky now. Digital banks offer yield, but sometimes restrict access. Traditional banks offer access, but low yield. Smart money blends both. Checking for access. HYSA for yield. T-bills for structure. This layered system protects liquidity. Banks profit from confusion. Clarity removes that advantage. Read fee schedules annually. They change quietly. Avoid unnecessary fees. Fees are negative yield and completely avoidable. Bank loyalty is outdated. Optimization is modern. Personal finance is now modular, not centralized. Each account has a role. Each dollar has a purpose. Random systems fail. Intentional ones survive. Survival leads to growth, always. Banks adapt faster than consumers. Stay informed. Stay flexible. Stay liquid. 100 min done. Personal finance in 2026 is strategic, not emotional. HYSA handles safety. T-bills handle structure. Credit handles flexibility. Banks handle access. Each plays a role. None should dominate. Balance creates resilience. Resilience creates opportunity. Opportunity appears after downturns, not during hype. Prepared households act calmly. Unprepared ones panic. Panic is expensive. Preparation is profitable. Systems beat willpower, always. Automation reduces mistakes. Consistency compounds results. This is how smart money behaves. Quietly, methodically, without headlines, without noise, without urgency. 2026 rewards clarity, not chaos. Calm money lasts longer. Longer money grows bigger. Survival comes first, growth comes second. This order matters. Ignore it at your cost. Use it to your advantage. Personal finance is a skill, not a personality trait. Skills can be learned and systems can be built. That's how wealth starts. 120 min complete.